Hello, everyone. Luke Gromen, FFTT. Hope everybody had a great weekend. Beautiful weekend here. Perfect weather, nice and sunny. So, hope it was nice for you as well. Let's jump right in. Start with the first question from NS. Hey, Luke, one of your tree ring subscribers. Thank you very much. In relation to the Weimar chart with wild swings and the old German Reichsmark versus gold, do you think wild swings are going to happen with everything in the next few years, even with sectors you recommend in weekly tree rings reports? It would help with emotional control. Thank you. I get it. Trust me, with everything going on, it's at times it's pretty crazy out there. So the short answer is yes. I think we have been seeing, and I think we will probably see everything continue to swing. I think really what we've been seeing since 4Q18, right? Remember, we had stocks fall 20% peak to trough in 4Q18. It was the biggest drop in decades. And then the Fed turned around and boom, we have a rebound. And then we have volatility in short-term rates in 3Q19. Repo rate spike, boom, spikes to 8 to 10%. Fed comes in, switches the balance sheet or goes from shrinking the balance sheet to growing it again in not QE to bring those repo rates down. Boom, you have a melt up in stocks. COVID, melt down, and then Fed comes in with huge QE, melt up. We've seen a melt up and then melt down in crypto and in Bitcoin, which, as you guys know, is really what we focus on in the crypto world. So I think we're seeing it. I think we're seeing it shorter and shorter intervals, and that's why I think the key takeaway from that chart is and something I've been repeating is we are going through the first bursting global sovereign debt bubble in 100 years, in my opinion. We are going through the first change in the global currency system in over 50 years. It's not a time to be levered. It is for the average individual, for the average investor, it is a time to be conservative with the leverage, because it's the leverage that kills you in these swings. Have a pretty high degree of confidence how this cycle is going to end. We don't know how we go from here to there at any given point in time, but it's highly likely to be volatile, as you see in that chart. And that's what I really think is the key message is where do we want to be as we have a longer term view of it, and then just understanding where we are within those short swings. I think within that, things like gold will swing less. I think things like Bitcoin will swing more. I think commodities, energy is a little bit of a special situation here, and we'll touch on this later, but the supply situation is getting worse and worse, and as a result, it actually normally would be a much more volatile commodity in this situation, but it hasn't been, and there may be informational value in that. Stocks have been volatile, bonds have been volatile. So you're seeing these swings, and so I think they are likely to continue. They are likely to continue at ever shorter intervals. Now from Jerry. Hi Luke, would love to get your take on a gold versus Bitcoin comparison, not regarding their respective characteristics or properties, nor which you may prefer, but rather which in current economic conditions you feel the market will favor and why you feel that way. In my opinion, the market's going to favor Bitcoin in rising liquidity environments like we saw from, call it, April 2020 through June of 2021. And gold, it'll favor gold in illiquidity, receding liquidity environments, like we've seen June 21 through today. I also think gold's value has more implicit reset value since it's on central bank balance sheets. And what I mean by that is, on current course and track, really the way this ends is basically a massive write-up of gold. It mechanically creates dollars, devalues the debt with the way it works with the U.S. With the gold on U.S. balance sheet vis-a-vis Fed operating manual. And so I think ultimately some sort of reset value of gold is much higher than where it trades today. There's some time between here and there, but because gold is on central bank balance sheet, I think it has some reset value, but that is just more for informational. To answer your question directly, I think once we get this turn in liquidity, which I think will be in response to the economy getting much weaker than people realize, that I think is happening as we speak, I think in the short run it favors Bitcoin over gold, with the key caveat that if central banks decide to keep raising rates into that, it's going to favor gold, not Bitcoin. So I think more liquidity is coming sooner than people think, though. So From Lindsay and from PM, kind of two questions that are in the same vein. How high do you think the Fed can take the Fed funds rate before something breaks? How long do you think Powell will go on hiking without a pause? Or what his target Fed funds rate is over the next 6 to 12 months? I personally think he's planning to hike monthly until something systemic breaks, regardless of the stock market pain, but could see him pausing prior to midterms. I think something has broken and people don't realize it yet. I'm hearing the U.S. economy has not slowed. I'm hearing it has slammed on the brakes, like bounce your face off the steering wheel, slammed on the brakes. And so I think it's going to start to become more obvious in the next 6 to 8 weeks. And when it does, if it does, when it does, then I think we've reached a critical moment, which is, what does the Fed do? Do they let people twist in the wind? Do they let the economy crash? Do they let the stocks crash? Do they let everything crash right ahead of a midterm? I don't think they do. And so I think we have already broken what we need to break. I mean, look, they've broken crypto, they've broken froth, the housing market's rolling. You're seeing inventories of houses at 9 months of new home sales. Every other time in 50 years that new home inventories have hit 9 months of sales, we've either been almost on the brink of a recession or already in a recession. So I think what needed to break has begun to break. They got to be very careful. They break too much, the amount of QE they are going to need to do to keep the system from collapsing will break their credibility. From Warren, your thoughts on the highest yield that could be reached in this hiking cycle using the 10-year bond? I think this ties into the point that I just talked about before. Technical people I really respect in terms of their view on what 10-year yield is, where it could go before it starts to get really nonlinear or chaotic. I've heard you hit 3.4% on the 10-year, you could see the 10-year go to 4.7% really, really fast, driven by hedging, selling, etc. It just feeds on itself. Banks, mortgage players, they all have to hedge exposures. That's selling treasury bonds. That's dry. So you could go 3.4%, 3.5%, 4.7% really, really quickly. If you get that kind of a non-linear move higher in the 10-year yield, that has enormous implications. And number one, I think it's bad for everything but the dollar, basically. I think you would see basically everything but the dollar go down in that case. I don't think it would last for very long, though, because ultimately, now you're getting into systemic collapse risks. You're going to be talking about the housing market screeching to a halt. You're going to be talking about impairing the value of real estate across bank balance sheets. You're going to be sending stocks down sharply. And at that point, I think you see the Fed back off really fast. And again, it's going to be a horrible look for the Fed if that's how the way it goes down, is now they've got to come in, instead of just backing off on the rates, they lose a lot of credibility. They knock markets down, and then they come right back in to save markets, because at the end of the day, with equity market cap still where it is, the stock market effectively is the economy via the consumption link, via the tax receipt link in terms of marginal consumption. So gun to my head, I think that's how it goes down. I think ultimately the supply-demand side on treasuries, I think you see tax receipts come in pretty light in the next couple of months/quarters. And as that happens, you end up with more supply of treasuries, less demand for treasuries. I think if you do break above the 10-year, above the 3.4%, things start to get really, could get really nonlinear, and then things will move really fast. And I think really fast is down fast, back up to new highs just as fast, because the Fed's gonna have to react, in my view. From Kurt, what do you expect to be the fastest horses when the Fed knife finally touches bone and is withdrawn? Energy, commodities, and Bitcoin. Ultimately, are, I think, the fastest horses, and certainly the fastest horses that I myself put my money to work in, which is maybe some of the lesser quality cryptos would go higher, faster. I'm not wired that way. I would rather own what I understand and own the proof of work side, which I think has a much better longer term outlook, use, etc. From TT, can you comment regarding oil windfall profit taxes in the EU and maybe the US? What will this do to the price of oil and everything else? I think it's self-defeating. I think it's, to be blunt, stupid, short-sighted, ahistorical. All you're going to do is reduce capital flows into energy at a time you need capital flows into energy rising. You're going to send prices higher into a downturn. It's going to make the stagflationary impulses worse. And this is something everybody learned 50 years ago, but of course, all these policymakers now in their 60s and 50s and 60s either don't remember it or were very young for it or think they're smarter than their grandparents were, or know better, and they're just making the same mistakes. They're basically reacting to a political outcry rather than addressing the real situation, or as I've coined the phrase, managing to optics, not managing to outcomes, which is how we got in this problem in the first place. So, bad idea, higher oil prices, higher gas prices, more inflation and everything else. And so I think it would be what we're seeing today on steroids. And then the final one for tonight from Andreas. Will we have a pullback in commodities through the summer on positive inflation going down and war ending narrative, or commodity and energy markets have been destroyed too much for this to happen? I think you need truly massive demand destruction in the economy just to get oil and gas down at this point. And quite frankly, I tweeted about this last week, where the supply-demand side on energy is so strained, in my view, that the amount of demand destruction that you would need is going to put sovereign bond markets, global bond markets, at risk of default to get oil down. And so I think the demand destruction, it would just have to be an enormous number. And when you start putting the default risk on the table for sovereigns, would you rather own energy or would you rather own a sovereign bond with default risk? I'd rather own the energy, right? So you got to be very careful if you're a policymaker in what you wish for. In terms of geopolitical, I do think if you got some sort of peace or ceasefire in Ukraine, or if you had Putin replaced by a Western proxy like a modern day Boris Yeltsin, who can basically get the Russian energy industry into under control of more Western hands, then maybe that would be seen. I don't know it would do a lot actually for supplies at that point, but I do think it would take some of the risk premium out of oil to the extent it exists. So I think you'd really need basically the system to collapse, or we saw that in March 2020, and the supply-demand situation wasn't even as stressed as it is today, in my view, which is you got oil down by basically shutting down the world. If you shut down the world again one way or another, I think you get oil down. But I think it's really noteworthy. China basically did shut down, and oil didn't move. I think that might be the most important development of the second quarter that very few people are talking about still, as best I can tell, is China was really shut down to a pretty good extent, and oil didn't fall. So ultimately, I think it's going to be really hard to get the demand destruction needed to drive oil down. If you don't get oil down, you're not going to get ags down. I think you've gotten some of the metals down, but ultimately, I think the energy ag complex looks really good from a fundamental standpoint. So with that, I am going to end for today. Thank you as always for joining me. If you want more information about what we're up to or learn more about our tree rings product, you can check us out at FFTT-LLC.com. As a reminder, tree rings 10 most interesting things, synopsis of what has grabbed us about those things in terms of being interesting, both either supportive of or refuting of how we're thinking about the world and those topics at the time. So as always, thank you for joining me. Everybody have a great rest of the week. Take care.